Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with stocks creeping higher following another AI scare. The latest bout of risk aversion helping to drive bond yields down towards new lows for the year. Bob Michael of JP Morgan Asset Management writing, the US economy continues to operate at trend with continuing disinflation. Tax refunds and AI capex are nice tailwinds. All of this is good for the bond market. Bob joins us now for more. Bob, good morning.
Happy to be here.
Bond yields, new lows for the year. Very close to those levels right now. What's driving yields that much lower?
I feel that the bond market is sitting here with a growing stack of chips. We're getting all the chips from private capital and from equities where a lot of investment by clients has gone. As I talk to our clients, they still feel underallocated to fixed income. Our message is, come on in. We're great. We're the perfectly priced market. If I think about the Fed funds rate at 3 5/8, I like it. Even if inflation runs at about 3% this year, you're talking about positive real yields on Fed funds of 0.6%. You look at the 2-year Treasury, it's near the Fed funds rate. That looks pretty good at 340 or so. You've got about 60 basis points of steepness out to the 10-year. That looks reasonable to us. You're just over 4%. You look at credit spreads for an economy that continues to expand with some tailwinds, they look fair to us.
There's been some doubt, as you know, about how bonds would perform in an equity correction. Are we beginning to prove the doubt is wrong with recent price action?
I think so, and I think we've long talked about the long end becoming unanchored, seemed to have gotten overdone, that the pain trade for this year was going to be a bullish flattening of the yield curve. We're starting to see that now. Investors are recognizing they can go into bonds. There is yield there. It is the counterbalance to risk.
You say go into bonds. You're talking about treasuries. You're talking about long end and you're talking about short end. Does this kind of rally in the government bond space mean something bad for the riskier space?
I'm talking about the entire bond market. I think most of the client base that's coming into the bond market isn't surgically thinking about treasuries versus credit. They want to buy an aggregate bond fund, a core plus bond fund, an income fund, a bond opportunities fund. In those benchmarks, there are going to be a lot of treasuries, but there's a lot of credit. That money is coming in and it's buying all sectors of the market. I'm not worried about credit here as long as recession isn't on the horizon. And right now, recession seems a long way off.
Your CEO is talking about how there are some problems brewing and there are people acting in irresponsible ways in order to get extra net interest income. There's this feeling that maybe there is a canary in the coal mine that is mounting in private credit. We did see high yield bond spreads blow out a little bit yesterday. Do you see any issues percolating there?
Your producer promised me no hard questions today.
You did. No one told me, so I didn't get the memo.
Ever. Look, I have a lot of sympathy for Jamie's view. One of the things that we've been looking at is CLO equity prices and how those have dropped. For those of us who have been around for a long time, it's reminiscent of what we were watching in the 05 to 07 period going into 08. There were things called asset-backed securities, CDX, so indices. And if you track the BBB minus portion of that, which held in for a long time, they also plunged. So it's looking like the first loss pieces of structured credit, much like that 05 to 07 period, are starting to crack. Now, history doesn't perfectly repeat, but it rhymes. It's something to keep an eye on.
Do you see them as liquidity issues or asset quality problems? Is it one or the other right now?
It's a combination of both, right? Because as loans are created, depending where they're created in the broadly syndicated loan space or in the private credit space, there's a different specter of liquidity on them. And where they go, do they just sit in portfolios and roll over? Do they go to create credit enhancement for CLOs? Those are also structuring problems. So I think it's a combination of both.
I'm going to avoid naming the names so you can actually talk about it. So if a fund comes out and has to send a portfolio of loans, has to sell them, and they get sold really close to par, does that end the idea that these assets aren't marked properly? Or does it just make you ask questions about what the other assets look like?
It tells you that things are functioning okay right now for the first movers. I think that's good. I think as long as the economy continues to move along at trend or higher, I always say a rolling loan gathers no loss. Those loans will be rolling, and then the amend and extend and the restructurings that are going on behind the scenes, they'll continue to go on behind the scenes. That's fine. I think what everyone's worried about is we haven't had a shakeout in private credit yet, and a recession is that ultimate shakeout.
Do you prefer liquid credit right now to private credit as a result of that dynamic?
I think it all just comes down to the borrower. I don't mean to evade that, but ultimately, if you're a credit picker, you've got to examine the borrower, and no two borrowers are identical.
So you're very constructive, unlike maybe other people that we heard yesterday from JP Morgan, but you did say in your note that there is a new level of geopolitical and economic uncertainty given what the administration is doing, fighting back after IEEPA was struck down. Why is that, though, if they're just filling the hole with another 10% tariff level?
Because of all the confusion it creates for corporate America, if you've paid the tariffs, you're entitled to get that money back if they were IEEPA tariffs. So you've now got to go through the process of reclaiming that. It's not quite clear what new tariffs will look like. Yesterday, the thought was 15%. That was just mooted. They're actually 10% with the threat of 15%. We don't know what the sectoral tariffs are like. When we talk to the businesses that we extend credit to, they seem to be frozen again, just as they were starting to understand what the cost of tariffs would be and the impact of AI, what happens in the last couple of days. Both of those become news items again, and it kind of freezes them from thinking about CapEx in the coming year.
Freezes them potentially also from hiring. Is that an issue right now you think corporate America is dealing with?
Yeah, when you look at the stasis in hiring, it's been that low fire environment for exactly those reasons. You didn't know what your profitability would be after tariffs. Just as you were starting to get through that, we're going to have a new round of tariffs. And of course, there was always AI out there. You didn't want to hire a load of people if in 18 months you had to replace them. And just as they were starting to understand that, there's more noise there.
Bob, we've known each other a long time. How many times have we had 10-minute conversations about fixed income without talking about the Federal Reserve? How new is that? It's a welcome reprieve from talking about that. Is that the same with clients at the moment? They're not asking about the Fed in quite the same way as the story shifted?
No, they're still concerned about Fed independence. They're still concerned about the nominated Fed chair and what that will look like. They're still expecting multiple rate cuts this year. So clients do still talk about it a lot.
Emphasis on nominated. What do you mean by that?
Well, he has to get through the congressional approval process. We'll see if it happens. I think it was a pretty clean pick. You have someone who was there 12 years ago, who has a body of work, looks like a very good candidate to us.
You say if. I would say when. We'll see when it happens, but you say we'll see if it happens. If you've got doubts that it happens at all.
Yeah, Congress, I'm probably in the 80-20. It will happen.
Sure.
But there's got to be some noise along the way. When you look at what's going on in Congress, what's going on in the administration, the midterms coming up, and the new Fed chair would take their seat in May. That's getting pretty close to electioneering for the midterms. I think it could become a political event.
Stay with us. More Bloomberg surveillance coming up after this.
President Trump's new 10% global tariffs are now in effect. As part of the effort to preserve the administration's trade agenda, the White House is working on a formal order to increase the global tariff rate to 15%. Joining us now to discuss is the chair of the Global Trade and National Security team at Lowenstein Sandler, Doreen Edelman. Doreen, welcome to the program. Can we just take a step back and start on Friday and give us a sense of the picture that you're articulating to clients at the moment, what the policy sequencing is going to look like from here?
Great question. So on Friday, it was not unexpected that the Supreme Court invalidated the tariffs under IEEPA, because under the law, it was very clear, at least 6 of the 9 justices agreed, that tariff power is reserved to Congress. The president overstepped his authority. And I think we can even see that with Trump's reaction. He talked a lot about his new tariffs in his Truth Social post and on his press conference, or during his press conference, but he did not say that he was going to challenge the Supreme Court decision. He's going to work around the Supreme Court decision. So we've got that the tariffs are illegal. Therefore, any tariffs will no longer be imposed going forward, and any tariffs that were paid should be refunded, period. That's clear. The court even went on to say that you don't have to have filed a lawsuit in the Court of International Trade or anywhere else to get the refunds. The question comes in, though, is how are the refunds going to be administered? What is the process and what is the timeline? And that is what concerns every company I know.
Well, when you speak to companies, what are you telling them in terms of how they should think about the timeline?
Exactly. We're telling them, use the procedures that are currently available. Under the customs regime, there are procedures for refunds. There's 2 sets. Because remember, we're waiting. The Supreme Court told the Court of International Trade that it needs to put a process in place so that Customs and Border Protection, CBP, can issue these refunds. So while we're waiting, the existing process is that companies can go ahead and file one of 2 ways if their goods have not liquidated. And what that means is when you bring goods into the United States, you pay your tariff. But that process is not finalized between you and the government until approximately 314 days later, and that is called liquidation. So if a company has imported goods, but they haven't liquidated yet, they can file what is called a post-summary correction. And that means that we're telling the government we made a mistake. The IEEPA tariffs are illegal. Therefore, we made a mistake in what we paid you and we want a refund. Pretty simple. Sounds pretty simple. It's a typical administrative procedure. That is one thing they can do. The other thing they can do is if their goods have already liquidated, the court has gone far enough to say that we're not going to have that be a problem for you to get refunds. So because if your goods have liquidated, you can file another document called a protest. And again, you're going to say that the tariffs were illegal and we want a refund, and here are the documents showing we deserve it. Now, in theory, that is how it's done. The problem is that obviously millions of companies are doing it, and there are no time limits. On a PSC, it could take up to 314 days to get you that refund. When you file a protest, the government has 2 years to respond. So in this case, you have an administration that really doesn't want to roll back these tariffs. So
Doreen, it doesn't sound simple. If I could just jump in there, it sounds what Justice Brett Kavanaugh said on page 64 in his opinion. This is going to be an absolute mess. While we deal with that potential mess of refunds, and the administration is talking about this bridge to investigations, can you tell us whether or not you think using Section 122 is also even legal? And if we have another Supreme Court decision ahead of us?
I think there will be challenges. But again, that is going to take time. And those 122 tariffs are only good for 150 days, July 26th, and then they need congressional approval. So they can be challenged on the legality, but that is not going to change the fact that any importer is going to have to pay them starting today and through July 26th.
Stay with us. More Bloomberg surveillance coming up after this. Nvidia results coming out after the closing bell tomorrow. Beth Kindig of IO Fund, a tech-focused stock portfolio, writing Nvidia delivered its strongest sequential growth since Q4 23 last quarter. Blackwell Ultra will likely continue this strong momentum. Beth joins us now for more. Beth, welcome back. Let's just start with Nvidia and why this bull market, this rally, has stalled, even though these big tech names are putting up some major capex intentions.
Yeah, I guess I would counter and just say typically the market all along has misjudged Nvidia and many other AI semiconductors and AI hardware players. There has never really been a moment in the last 3 years where the market got it, except for maybe that one big blowout report with Nvidia. What they're missing now is that the way these GPU generations work is that they ship in volume production, which means this strong quarter we saw last quarter, which was one of the highest in 2 years. It's saying a lot. This company easily, comfortably beats basically every quarter. So saying a lot that it's the biggest beat in 2 years is likely to continue to flow. That momentum is likely to continue because GPU generations it's shipping in volume. It's in production volume right now. So what the market is missing is by keeping this stock range bound, it's now a valuation story. We're no longer at the Blackwell Ultra shipping is how big of a deal is Vera Rubin. We're at this stock is dirt cheap because it continued to put up strong quarters. And now the market kept it range bound. So personally, the way I look at this is it's a valuation story going into tomorrow night.
Calling it dirt cheap after it rose to be $4 trillion and then nearly $5 trillion of valuation is definitely a bold call, Beth. I just wonder, to make it simple, how low is the bar right now for Nvidia to just sort of step over tomorrow afternoon?
Yeah, I would just counter and say I did not say the market cap was cheap. I said the valuation is cheap, which means on a sales ratio and an earnings ratio, we're looking at April lows. So I do want to make sure I clarify that.
Understood. I'm just wondering, though, going forward, given the fact that they have increased their revenues to such a big degree, and frankly, there will be more coming with respect to Meta and with respect to Microsoft and Google and the others. I'm just wondering how low the bar is. I mean, I do think that essentially if they show what they've been spending, even if they do have a big CapEx plan that they announce, that it will be well received.
I think going back to your point that this is the world's most valuable company, that there is not a low bar for Nvidia. I think the bar is always very high. And what I'm saying is that because the way these GPU generations ship, we're in volume production on Blackwell Ultra, that bar will likely be cleared this quarter. Where, I look at this forward and backward, of course, I'm very close to this stock. What we want moving forward is a smooth handoff to Vera Rubin. We want to make sure that generation ships on time. That is where I'm focused at this point because Blackwell Ultra is pretty much priced in.
Beth, do you think there are some doubts around that then?
There are only doubts because there was a little bit of a rough handoff to Blackwell. We had about a 6-month delay on Blackwell, and that is actually showing up a lot in this range-bound price action we've seen over the last year. The market has gotten complacent over the fact that there were these shipping delays. And it's simply because NVIDIA continues to challenge what is possible with compute. So there can often be moments where, while doing that, the way that it's built, qualified, and shipped, there can sometimes be some delays. I don't know that I think Vera Rubin's on time, but it's still something that you have to watch because they're doing basically the impossible.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.